Good day, guys. Welcome to GDS Academy. And our topic for today is on non-current assets. Yeah, it is non-current assets based on the course I'm taking, basic accounting process and system. So non-current assets falls under IAS 16. So IAS 16 tells us how to account for what? How to account for what? Items under property, plant, and equipment. That is what is basically talking about is our non-current asset. How do we account for it? You understand? So they will touch the short form or the basic form of IAS 16 because what we are dealing with is what basic accounting process, BAPS, for ATS1 students. So now what is an asset? Now, before I move into the classification and division of an asset, we know that an asset is meant to bring in resource into an organization. Do you understand? Therefore, we can see an asset is what? A resource. An asset is a resource as a result of past events in which it is expected to what? In which an expected future cash flow or benefit is meant to come into the business. So you can say it is a resource as a result of past events of which future what? Benefit will flow into the entity or the business or the organization. That's just the simple definition of what? An asset. The keyword resource as a result of past events, then what? Future what? Cash, or let's just say future inflow is expected into the organization. So that's that on what? An asset. An asset is divided into two. We have the non-current asset, which is our main deal here, and we also have what? Let me label it NCA. Then we also have our what? Current asset. So let me deal with current asset. So according to IAS 1, that is presentation of financial statements. Now, for those that don't know the meaning of IAS, IAS means International Accounting Standard. You understand? I'll still make a video on what IAS is, what IFRS is, what IASB and the likes, what they all mean and what their function is. I'll do that along the line. But for now, let's come back to current assets. So current assets, they are assets that are let's say they are resource as a result of past events, which is expected to bring in what? Future inflow within an accounting period. Now, when I say an accounting period, I'm talking about 12 months. That is 12 months after the reporting date. You will get to know what this is. So, an example or items of current assets, we have our inventory, we have our cash, we have our prepaid expenses, and we have what? Our accrued income and the likes. We also and other receivables based on that, because that's not our focus for this class. Our focus is on what? Non-current assets. Now, non-current asset itself, it is an asset that is expected to last for more than an accounting period. You understand? So since it is expected to last for more than an accounting period, let's label it properly. So we have tangible and what? Non-tangible or intangible. So tangible non-current assets, they are assets that we can see and touch. So these are the basic ones that we get to see mostly in our what? Statement of financial position. While for the intangible non-current assets, they are the non-current assets that we cannot see and touch, but it exists. Example is where we have our franchise, patents, copyright. Okay, let's copyright, patent right. Sometimes we have some royalties. Here we have our, let's just say our PPE, property, plant and what? Equipment. So that's what our tangible non-current asset is talking about. Yeah, so these are basically what you need to understand on our non-current assets. Then for this measurement. So we have initial measurement and subsequent measurement. So for initial measurement, how do you record our non-current assets at our initial measurement? For in our initial measurement, our non-current asset is recorded at the cost initial measurement. NCA, that's non-current asset, is measured as what? The cost in which it was what? Purchased. That is the cost whereby the cost of what? Acquisition of what? The non-current asset. That is a past event, not a future event. You understand? If it is a future event, then it is no longer a non-current asset. So for it to be a non-current asset, it must meet the definition of an asset, which requires what? Past event. So yes, the cost. Now, what is the cost that we're talking about? The cost is what? The cash, let's call it the purchase price or the purchase consideration, and cash and cash equivalent, or other considerations such as the fair values that are involved in what? In the acquisition of what? The asset. You understand? So this acquisition cost is what I'm going to lay down in the basic form based on basic accounting process for level 1, for ATS 1. You understand? So these are what? Let me come again. The purchase consideration, that's what I prefer to call it. Purchase consideration in what? In getting the what? Non-current assets. When I say purchase consideration does not necessarily mean cash or cash equivalent. There can be other means of what? Payments for what? Our non-current assets. You understand? Now for subsequent measurement, it could be for subsequent measurement. It could be in form of cost or what? Net realizable value or evaluation. You understand? Some will call it net realizable value. It is in between these two. You can record it as what? The cost or what? The fair value. Some call it fair value, they call it evaluation, or net realizable value, any of the three. But most likely they make use of both. You understand? You can choose to value it in your cost. That's for this only apply to subsequent measurement. But for initial measurement, you can only measure it at what? The cost. Now, the component of acquisition cost. Now I'm just going to summarize it into two. Now I'll call this the purchase price. That is, this includes import duties, plus non-refundable levies. Then you less what? Trade discount. If you don't know what trade discount is, go to our source document video or on our subsidiary book. You will get to understand what trade discount is. Then any cost directly attributable to the what? Cost that is directly attributable to the non-current asset. Now, any other cost that is involved in, it could be either in bringing it or the cost of installation and various other costs that are involved in what? Making sure the non-current asset is in working condition will be part of what? The component of what? Our acquisition cost of non-current assets. Now let's solve a question on a very short and brief question on non-current assets. Now let's solve an illustration. This illustration is I picked this illustration from Basic Accounting Process Study Text, illustration 6.1. So where we have flat work, that is in Siriano Limited, orders the machine from Nigerian tools manufacturer at an invoice price of what? 100 million. Payment will be made in 48 monthly installments. 2.5 million 2.5 million naira, including 20 million interest charge. Other relevant costs include, we have our value added tax, freight charges, installation and other startup costs, trade discounts given. Now, what is the cost of the capital? What is the cost of the machine to be capitalized in Flatwork Sierra Leone Limited? Now, like I said, let's follow this step that is going to help us out in solving this properly. Now, the first price is what? Invoice price. Now, the currency really matters a lot. So, what's the cost? 100 million. Now, immediately we got the price. Is there any import duties and non-refundable levies here? No, there's nothing of such. So this will remain. But what do we do? There's a trade discount. They give us a trade discount of 1 million. So we'll deduct it, trade discount. So this will give us 99 million. Then after that, let's look. They said payments will be made in 48 months instrumentally. Remember, I said for initial measurements, it has to do with past events, not future events. So this 2.5 million, including 20 million interest charge, will not be included as the cost of our non-current assets. You understand? So that will not be included. Instead, what are we going to add? We will add our value added tax, VAT charges. How much? 12.5 million. Then what's next? We will add our freight charges. How much? 10.25 million. Then what's next? Cost of installation. Okay, let's call this installation cost. How much? 4 million. So if we should sum this up, it will give us 125 million 750,000 dollars. Now, this is not the end to this class. You understand? We still have a long way to go in these are non-current assets. So in a subsequent class and more classes to come, we'll discuss depreciation. So this is just basically how you allocate what the cost of the machine, that is the cost of the non-current assets. You understand? Then once you know this and you understand it properly, then we are going to teach you how to depreciate. Then after we have taught you guys how to depreciate, then we also focus on measuring our current non-current assets in our subsequent year. You understand? This means initial year, this means subsequent year. So we teach you how you are going to get all of that and understand it, and we'll be making use of ATSY insights. We'll relate it to more of your exam and how you can understand this properly. So if I'm sure you must have understand one or two things new as regards non-current assets. So this is where we are going to be stopping for today. Kindly like, subscribe, turn on the notification bell, and share with others that know that they cannot afford to go for a professional tutorial so that they can learn from this. And if you can, it's advisable you go for it too as well. Thank you very much. See you in our next class.